Hi, I'm Tom Selzer from Livewire Markets, and joining me today is Frank Danieli from MA Financial to talk about the MA credit portfolio notes. Frank, thanks for joining us.
I'm good to be here.
Frank, you've announced the launch of the MA credit portfolio note, which will be ASX traded under the ticker MA2HA. I think this follows the launch of your listed investment trust, MA1, earlier this year. But why launch a listed private credit note, and why now?
Yeah, well look, we're one of the largest and most scaled private credit managers in Australia, and we're really excited now to bring our suite of funds, which historically were only available in an unlisted format, to the listed markets. As you say, we've done that with MA1, a listed investment trust, and now these notes. The notes are unique and they bring a capital buffered product from our suite to the listed markets for the first time. This is a type of product we've been actually operating for the last 7 years in our unlisted suite, so we're really excited to bring it to the listed market.
And so what do you say are the key differences between these notes and MA1?
Yeah, that's a good question. These notes are not the same thing as MA1 wrapped in a note format. It's actually a different underlying portfolio, different strategy for, in our view, a different part of the investor's portfolio or different type of investors. So our MA1 product, which is a listed investment trust, that is a fund structure listed on the ASX. And what it's trying to do is to capture the alpha that's available out there in private credit through proprietary origination. It's a fund structure and it targets a cash rate plus 4.25 percentage points per annum. It includes a quite wide array of the private credit that we do. The notes have a narrower set of portfolio guidelines. They're designed to be a core fixed income alternative, and they are in a note structure. That means there's a call date and a hard maturity date. So there's a call date of 6 years and a hard maturity date of 7 years in the portfolio. There's an interest rate that is payable on the note, and that is an obligation that comes from the portfolio, and it's cumulative through to the note term. The underlying portfolio here is also different. So in MA1, we have exposure to our direct asset lending, our direct real estate credit, some of our construction and development finance, as well as some of our offshore, more specialized strategies across the board. In the notes, we've got a narrower set of portfolio guidelines, and they're really designed to create a true fixed income alternative style of product here, and it's that style of portfolio. There is a 0% hard limit on no exposure to construction and development finance. There's no direct real estate lending in the portfolio, and it doesn't include some of those more bespoke and higher yield strategies. It's asset-backed lending and it's corporate lending, which we believe really have that core fixed income characteristic.
And maybe just taking a quick step back here, how would you say MI Financial's strategy differs to other managers in the private credit space?
Yeah, well, our strategy in private credit is that we are trying to create fixed income alternative products. And the way we do that, we have a large scaled platform, we have big, deep, diversified and experienced teams. But the key things we focus on are really 3 things, and we think they make us a little bit unique. We're very focused on alignment, proprietary origination, and workouts capabilities. What each of these things mean is we believe in credit that as a manager, you should be co-investing with your clients. We do that at MA Financial. Today we have about $230 million from the firm and staff co-invested in our underlying strategies with our clients. So we really eat our own cooking. Secondly, as investors too, we really care about what types of credit, what types of loans are going into the funds that we manage. And that's why we focus on proprietary origination. We want to be the one out there structuring the terms, the pricing, the security, the covenants, the features of these loans and sourcing them for our funds. We've built a proprietary lending ecosystem that spans our relationships, platforms we own, one of the largest pieces of financial infrastructure in Australia that's part of our group, and strategic partnerships that we enter into to create a really wide funnel of origination opportunities for our funds. We now see over 30 billion a year of deal flow opportunities. We curate from that. We still only execute maybe 5 to 10% of what we see, so we're selective, but we set a really wide funnel of opportunities that we can execute on. And we think that's really important in the world of lending. The other thing that happens in lending is that we believe credit is all about avoiding losers, not picking winners. It's almost the opposite way of thinking to equities. In our business, we can only get our principal back when we make a loan and get the interest that we're contractually owed. So we need to make sure we have big diversified portfolios, we have the right security, asset backing or defensive features in the loans we make, But most importantly, if something goes wrong, we need to be able to go in and get our money back on that individual position. And we've got a real advantage there because within the MA group, our advisory business is the leading firm in Australia in special situations and restructuring. We understand the dark side of credit, we know what goes wrong, we use it to avoid problems in the first place, but if something doesn't work, we know how to go in and to fix the problem.
And how would you say these notes fit into that strategy and maybe, your longer term vision for the asset class?
Yeah, well, we really believe at MA that there's going to be a convergence between private and public markets. These things are going to come together. What we're trying to do in the world of private credit is really to find areas where banks used to lend, but they can't lend anymore. And that might be because of regulation, market structure changes, or it might be areas where the banks just aren't efficient. And these are really big opportunities. The lending markets are very large. In Australia, over $3 trillion, globally, many, many tens of trillions of dollars. And so you're stepping into these big verticals. And so we're trying to do that style of fixed income. And we think that bringing our unlisted style of products to the listed markets is really helpful because it creates more access points for investors depending upon their own risk tolerance, their preferences, what they need for liquidity, as well as the returns that they're seeking.
And I think you touched on it there, filling maybe that vacuum left by the banks. I think notes give investors exposure to asset-backed lending, direct corporate lending as well. Do you mind explaining a bit maybe about the opportunities you see in that?
Yeah, that's right. So the strategies that these notes focus on are asset-backed lending and corporate lending. And so if you think about what those two things mean, asset-backed lending is, we think about it just as real-world finance. Big portfolios of loans, home loans, car loans, business loans, equipment and asset finance. And it can be things a little bit more specialized like receivable finance and so on. These are really big diversified portfolios of loans. And so what you're doing is not taking a view on just one particular loan, but how a whole portfolio of them are going to perform. You get a lot of diversity embedded in your portfolio doing this. For the portfolio here for the notes at the outset, which will be an nearly $2.8 billion portfolio at the outset, over 94 positions and 16 lending segments within it, that diversification is embedded. About 80% of that book is in asset-backed lending. It includes over 700,000 underlying loans and receivables across that portfolio, so real diversity. And then the other thing we do, about 20% of the portfolio at inception, is in corporate lending, and that's where we directly lend to companies. And we're looking for companies with sensible levels of leverage, that have real cash flow capability to service their loans, that they've got a real market position in their space, and where there's a lot of equity behind us.
You mentioned it earlier, but I think investor alignment's a big focus for MA Financial. I think these notes have a capital buffer. Do you mind explaining how that works and what that means for investors?
Yeah, look, we really pioneered capital buffered products generally, we believe, in the private credit markets in Australia, having done this since, or at least for 7 years, in our unlisted suite. The notes have a capital buffered feature. And what that basically means is that when we raise the notes here, the notes will be issued by a subsidiary of MA Financial and backed by a portfolio of credit that we just talked about. And then an MA Financial Group entity will invest a capital buffer. So that will be 5%, the size of the notes, and that capital buffer is first loss. So if something goes wrong in the portfolio, it's the capital buffer that loses first. We think this creates a real alignment of interest because as the manager of the note portfolio here, we're very incentivized to invest in good quality credit that's going to perform, that will deliver note holders their target or the interest rate on the notes, which is 3.25 percentage points per annum above BBSW, and that we can actually deliver a portfolio here that will meet the objectives for the notes and for investors over the horizon of the notes.
And obviously in terms of listing on the ASX, what does that mean for investor access, liquidity, transparency, things like that?
Yeah, well, the ASX is a great way for investors to have access to a daily tradable way to have exposure to private credit, and that's really what the notes provide. We think, and I mentioned the point of convergence of public and private markets earlier, I think that the listed markets are a really good place for private credit actually, because you do have really good investor engagement. You under continuous disclosure obligations as a participant in the ASX market, and there's a lot you can do around investor engagement so people can really understand what they're investing in. We're really big on governance and transparency at MA. If you look at what we've done with MA1, our first listed product, we're putting out significant portfolio disclosure on a monthly basis, more detailed quarterly disclosure, now including loan by loan disclosure of everything that's in the portfolio. We're transparent around things like fees and the nature of the underlying assets, where they're coming from and the performance, and the same thing will apply here. And I think actually a listed structure really drives you towards that outcome, which I think is a good thing for the industry.
And finally, where can investors find out more about the notes?
Yeah, investors can find out more at mafinancial.com, and the ticker will be MA2HA for the first note issuance.
Frank, thanks for joining us.
Thanks a lot.
Thanks for watching. Make sure to check out our YouTube channel and website for more great videos.